Hello, everybody. This is chapter 4 for this semester. Probably the least important chapter, and you heard that right. It's the least important chapter as far as exam 1 goes, because there are only two things I really care for you to know here very well, mathematically, I mean. The first is the additional financing needed formula. The second is cash budget. So I'm going to go over both of them. I'll do a problem on cash budget. AFN is just I need you to know how to substitute the numbers in the formula, basically. So financial planning for a company starts with strategic planning. Strategic planning deals with the overall direction of a firm. And once you have the strategic plan, you have several operational plans which will take you towards your strategic goals. Details of where a firm wants to be at some future point of time and what resources are needed to get it there. Like I do remember way back in 1998, I was just finishing my PhD. I read a interview from the CEO of Hyundai who said, we want to be in the top 5 automakers in the United States by 2010. I thought that's pretty ambitious because in 1998, when I was a doctoral student, the reputation of Hyundai cars was not exactly pristine in the United States. They were just beginning to offer the 100,000-mile warranty to ensure that their sales go up, and that's the reason why I thought, okay, let us wait and see. And actually today they are considered, they sell a lot of cars today. So I don't know if they're in the top 5 or not, but I do know one thing. They did turn around an opinion, a negative opinion about them among the population by now. Because I do know that Sonata sell a lot, and I know that they sell a lot of other cars too. So financial planning includes operational objectives. Okay, operational objectives, it requires marketing plan, production plan, human resource plan, financial plan. So what you essentially have is all these plans, marketing, production, human resource, financial plan, which lead you individually. They all are part of what is known as the operational plan. The operational plan is directed towards operational objectives, and these two interact with each other. I mean, the long-term goals of the firm are what leads to strategic plan. The strategic plan leads to operational objectives, and the operational plan, which stems from all these 4 and some other areas. In some cases, they have quality control is a separate area in itself. So all this, it's an overview. That means this is a continuous process. It's not a singular process where you decide, okay, this is what we want to achieve and that's it. No, this is a continuous process because things keep changing in the industry. So your marketing, your production, your human resources, your financial plan need to adjust to meet the operational objectives so as they can achieve the strategic long-term goals of a firm. Now, for all this, you require one thing, cash flows. Now, how does a firm generate cash flows? Now, that's not an easy question to answer. A firm's cash flow generation process is given here. You first raise funds using external, owner's equity and creditors' debt, and internal, which is cash flow. I mean, initially, it only starts with the highlighted part here. Once you do that and you send it, you use that to acquire assets, and then you produce and sell goods and services. After that, you make profits, and that profits can be used either to distribute to owners and creditors or funds for reinvestment. So, or you can do both. If you make sufficient profit, you can do both. Now, once you are able to do that, some of the money is reinvested, and that's internal. That's what they're talking about here. So this is a circular pattern that continues as a firm grows. The importance of cash flows, I mean, it cannot be underestimated. You started about this. I mentioned this way back in chapter 1. In finance, it's not profits that count, but cash flows per se, and cash flows are very important. Cash flows and shareholder wealth. The cash flow concept, like the after-tax cash flow, is nothing but earnings after taxes. And to that, you need to add back the non-cash charges. Now, what are the non-cash charges? Essentially, these are the non-cash charges. This is the major one, depreciation. Okay, depreciation is the amount that you write off as allowed by law. That does not mean you pay that money to anyone else, but you have that cash still with you. Even though it's written off as an expense, you didn't actually spend it. So your cash inflow has not reduced. So you add back the depreciation to earnings after taxes. And in case this is there, this is another non-cash expenditure, amortization. So, and also there is something else, deferred taxes. What are deferred taxes? The government allows companies in certain industries to use what is known as the MACRS system, whereby they are allowed to depreciate more than the normal percentage allowed under straight line method. Now, if you look at the appendix for chapter 9, and we will be doing it when we do chapter 9, they will allow you to write off a lot more in the initial years when the cash flows from the asset are at their highest. Normally, the highest depreciation is allowed in year 2. According to the table. Now, when you look at it, that means essentially you're paying less taxes in the initial years and more in the later years, right? And because of that, there will be deferred taxes. That means taxes which essentially got postponed. That's another thing you need to add back to get cash flow. So essentially what you have here is earnings after taxes plus depreciation, in case it's there, amortization, plus deferred taxes. This textbook does not consider amortization. I expect you to. So that will give you your after-tax cash flow, ATFC. Since the textbook does not use amortization, let us remove that. But if it is there, you need to include it because it's a non-cash expenditures. Let's just say this formula is the correct one. This is the formula to look at. Now, this is something I want to show you all. You see, this is what financial reporting purposes is. That means you depreciated using straight line method here, wherein you depreciate saying I'm only paying 10 million as depreciation, but MACRS allows you to deduct 12. Now, what happens when you deduct more depreciation is needed? What happens is, you see your cash flow, your earnings after taxes becomes lower when you use MACRS. You see this? If this is the way it should look like if you normally use straight line method of depreciation, and this is the way it will look like if you use MACRS. Now, because you have 18 as profit that they allow you to write off, you only pay 7.2 in tax instead of paying 8. So your earnings after taxes is 10.8 instead of being 12 here. Okay, now if you look at it, total federal income tax comes under two forms in a scenario like this. The first is the 7.2 that you actually pay. The other is the deferred taxes. That's what they're talking about. The 8, that is 800,000 they're talking about there is what is worth mentioning there. That's deferred taxes. You use the 8 to add back to earnings after taxes, which is 12. Okay? Plus depreciation and amortization. Depreciation, amortization. It's 22.8 after tax cash flow equals, sorry, depreciation and deferred taxes. I don't know, I keep saying amortization. This is deferred taxes. So 12 earnings after tax plus non-cash expenses, these two, 22.8. That's how you calculate it. Now, how does a firm forecast its financial statements? If you look at it, percentage of sales forecasting method assumes that present level sales, asset level sales are optimal with respect to present sales. And most items on the balance sheet increase in proportion to sales increases. You have to start somewhere. So this is where you start. You say, okay, how am I gonna figure out how much money I'll need? So you base it on, okay, if right now our sales are 100,000, let us say they go to 125,000. So you think, okay, if our sales are 100,000 and our assets are 50,000, if our sales have to be 150,000, our assets will have to be 75. So most items in the balance sheet increase in the same proportion as sales increases. So like for example, this is a way to do it. If you look at this company starts off with 500,000 in sales. They expect a 25% increase here. So you see everything else, accounts receivable, inventories, they expect the entire balance sheet going up like that. See that? Everything's going up 25%. And the same thing for accounts payable and notes payable. Now notes payable actually is higher. No, only accounts payable. They increase that by 25%. Only accounts payable. Let me use my eraser here. There you go. Okay. Now that you know that, okay. Now income statement, sales 25% increase, and then you have expenses including interest and taxes. The forecasted is 17,750. So no change. Dividends paid, there is no change expected there. What is the total amount of financing needed? Forecasted asset increase minus forecasted current liability increase. That means the total financing needed would be assets by sales multiplied by change in sales minus current liabilities by sales multiplied by change in sales. Now, there is of course one other thing that you need to consider. If there is an increase in retained earnings, that means next year you will have some profit that you make from this year that you'll retain. So you need to account for that. So that brings us to the most critical slide of this chapter. This is the formula. Additional financing needed is total financing needed. You all remember what I'm going to be highlighting in yellow is total financing needed from the previous slide. See this? This is what I was talking about. That is total financing needed. From that, you need to deduct increased retained earnings. Total financing needed minus increased retained earnings, which is this part that I'm highlighting. In the textbook, there are examples that you can solve. I expect you to be able to substitute numbers into this and solve it. If you get a question on the exam about this. If I give you asset levels, if I give you sales levels, if I give you current liabilities levels, present and expected, and earnings after taxes and dividends, you should be able to do this. It is just substitution of numbers, straightforward. All right, moving on, we need to look at financial forecasting, which is based on cash budgets. Cash budget is basically this. You try to anticipate how much cash you would have either in surplus or you require at the end of every particular month. And based on that, you start looking for sources on where you can get the money from right now. Like for example, it would be a lot easier for me to know if I know 3 months from now I'll be requiring 5,000, I can make more arrangements in these 3 months than trying to find it on the last possible day. That's the advantage of preparing a budget and sticking to it. Now, cash budget is kind of like that. Now, projection of a company's cash receipts and disbursements over some future period of time. Now, you need to look at operating activities, investing and financing activities, and there are models that are generated. Okay, you can read about these things, but the best way to explain cash budget, according to me, is to actually work a problem on that. And that's exactly what I'm going to do right now. This is problem 4 in your textbook. It's in page 138. Okay, we are going to be working on this problem. It's problem 4. Prepare a cash budget for Atlas Products Incorporated for the first quarter of 2017 based on the following information. The budgeting section of the Corporate Finance Department of Atlas Products has received the following sales estimates from the Marketing Department. December 2016, they have total sales and credit sales. Okay, this is on page 138 in edition 14. That's where I'm doing this from. Okay, now let's do this. Okay, now what is it? If you look at it, the total sales and the credit sales. What is the difference between total sales and credit sales? They gave you in the first table total sales and credit sales. The difference between the two has got to be cash sales. Right? Cash sales. The company has found that on average about 25% of its credit sales are collected during the month when the sale is made. The remaining 75% of credit sales are collected in the month following the sale. As a result, the company uses these figures for budgeting. The company estimates that it purchases 60% of next month's sales, and payments for those purchases are budgeted to lag the purchases by 1 month. Wages and salaries, you got 250,000, 290 and 290. They got rent and other expenses for those 3 months. Since they have given us only 3 months here, it means we'll be doing cash budget for only 3 months. In addition, the tax payment of 105,000 is due in January 15th, and 40,000 in dividends will be declared in January but paid in March. We are only worried about when they are paid. Okay, also the company has ordered a $75,000 piece of equipment. Delivery is scheduled for early January and payment is due in February. The company's projected cash balance at the beginning of January is 100,000, and the company desires to maintain a cash balance of 100,000 at the end of each month. So what we initially do is we don't just jump into the problem. We do what is known as a cash budget worksheet. What is a cash budget worksheet? This is a cash budget worksheet. That means this is where we figure out what is what. They have given a bunch of information here. Okay, this is for the first quarter of 2017. So let us start with the first one given there. Okay. There is no doubt when wages occur, when rent occurs, when other expenses occur. What if there is a doubt? It's only with regard to when credit sales are collected and when purchases are paid. So that we need to be careful. And for that, we need to first figure out what are the cash sales, what are the credit sales, and which part of credit sales is collected when and which is collected later. For all this to work out, we need to be very organized. And that's what I plan to do right now. Teach you all how to be organized in doing a cash budget. Now, let's start with this. First of all, you have estimated sales. Now, we are preparing cash budget for January, February, and March. So, if you look at this, these are the estimated sales. January, February, and March. Now, these are the estimated credit sales for January, February, and March. The difference between the yellow and the blue is cash sales. We now know what the cash sales are each month. Now, I want us to find out how much of the credit sales is received in which month. Like, for example, if you look at this, what does the book tell you? The company has found that about 25% of credit sales are collected in the month in which the sale is made, and the remaining 75% of credit sales are collected in the month following the sale. Now, 25% of December sales are collected in December, which we don't need to calculate because December sales is not part of this cash budget. But what is collected of December sales in January is, so what you collect in January is 75% of credit sales from December, which is what? 75% of this particular number is collected here, right? 75% of January credit sales, which I'm using a different color, are collected in February, and 75% of February sales are collected in March. Now 75% of 770,000 is 577,500, right? I mean, let me just show you this. The credit sales in December are 770, right? 75% of that is multiplied by 0.75 gives you 577,500, which is what you got here. And in January sales you got 690,000 multiplied by 0.75 are collected in February, which is 517,500. Okay, now what about the rest of January sales? Like for example, that minus 690,000 gives you 172,500. 172,500 is collected in January itself. 1/4 of 780,000 of February is collected in February itself. 1/4 of 855 is collected in March itself. So total accounts receivable collections for any particular month is 3/4 of previous month's credit sales and 1/4 of this month's credit sales. So what you're getting in January is 750,000, and February is 712,500, and in March is 798,750. Now, purchases. We took care of the sales. We now know how much we are getting in sales collections, how much we are getting in cash sales every particular month that we need. Purchases. Purchases, the company has the company estimated its purchase 60% of its next month's sales. Now remember, this is total sales, not just credit sales. So 60% of January sales are purchased in, what is January sales? 730,000. 60% of that is purchased in, which is 438,000. 438,000 that we got here. Let me use the red color here. This is 60% of this 730,000. Just as this would be 60% of this, right? Let us check. Credit sales, sales in February is not credit sales. Sales in February is 840,000 multiplied by 0.6. That's how you much purchase in January, and so on. I mean, this goes here. So you now know, and you know that you get 1 month time to pay it off. So you pay December purchases in January. January purchases in February, February purchases in March. See that? It's simple. It's simple. So now that we are done with all this part, we took care of the hard part. Now putting it all into a cash budget. We took care of the worksheet. So now the cash budget. How do we do the cash budget? The cash budget is actually pretty simple. Okay, now that you have done all the homework, you have the pleasure of actually putting it into the numbers. You don't need December, you need only January, February, and March. Projected cash balance at the beginning of the month, 100,000. This is there always. Cash sales, 40, 60, 65. If you go back to the previous page, 40, 60, 65, you see that? This is what we are talking about, 40, 60, 65. Now, collection of accounts receivable. That means 75% of last month's sales and 25% of this month's sales. And if you go back, we calculated that here, 750, 712, 500, and 798, 750. See that? All we need to do is use it. So you add 100,000, 40,000, 750, you get a total cash available for 890 in January, 872, 500 in February, 963, 750 in March. Opening cash plus cash sales plus collection of accounts receivable, that means credit sales collections. You now know how much cash you have. Now you have to account for the expenses. Well, the first thing you account for is payment of accounts payable, which is your purchases. As we already saw here, your purchases were, let me use a different color, 438, 504, and 552 for those 3 months. So let us use the same here. Wages and salaries, rent and other expenses are given in the table. So we don't need to calculate those. They're already given to us. In addition, a tax payment of 105,000 is due on January 15. So that's for January. There is nothing in February or March. The company, 40,000 dividends will be paid in March. It only matters when it's paid. 75,000 equipment purchased in January but paid in February. So it only comes in February. You have to see when the cash expense actually occurs. That's when you need the cash. So the total disbursements, when you add all these, you get for this year, let me use green here. For January, it's 830. So you have 830,000 expenses in January, and your cash is 890. That means you have a surplus. If you look at your cash here, okay, it's 890. From that, you deduct 830, which is this. The difference is 60,000. You're 60,000 more. So in order to maintain a minimum balance of 100,000 for this particular month, you need to borrow 40,000, so that you already have 60. You borrow 40,000. That will leave you with 100,000 that you start February with. See this? February starts with 100,000. Every month they want to start with 100,000. Now, think of February. In February, your total cash you have, including the 100,000, is 872, 500. But your total expenses in February are a lot higher. Okay? They're a lot higher. They are actually kind of like 908,000. So you actually are short by 35,500. So you're short in February. That means your expenses exceed your inflows by 35,500. You not only have to account for this 35,500, you have to account for the opening balance in March of another 100,000. So you need to borrow a humongous amount of 135,500 to not only pay this extra money that you require in February, but to open March. But you open March with 100,000. Let us go back and look at March. In March, you have 963, 750 cash available. As you can see here, you have 950, 63, 750. And your expenses are 923. So you're actually in a surplus of 4750. As you see here, it's 40,750. Because you see your expenses were only 923. So you need to borrow just 59,250 to keep the minimum balance at 100,000 for the next month, that is April 1st. So that is what is the whole point of this exercise? The whole point of this exercise is one thing and one thing only: to find out what exactly you need here. And the earlier you know this, the better arrangements you can make to get that money. That is what a cash budget's purpose is. Its purpose is to enable you to buy stuff. Look around for the best possible rate to finance it with. Let us say you tell your banker, hey buddy, I'll need 135,500 at the end of February. The banker will be prepared. He doesn't want you knocking on his door that morning and saying, hey, I need this kind of money today. I mean, they may be able to help you, but it is a lot better if you give them some time and say, I'm short this month. I'll be needing money. That's the advantage of cash budgets. That is chapter 4. We are done.